Forget Bitcoin. Forget meme stocks. Zimbabwe just pegged its entire currency, the ZiG, to gold and a basket of foreign currencies. We're talking a country that saw inflation hit 231 million% in 2008. So, could this actually work? Or is it just another chapter in a long, painful economic history? The Reserve Bank of Zimbabwe, led by Governor John Mashayabanu, launched the ZiG in April 2024, backing it with 2.5 tons of gold and $100 million in foreign currency reserves. Their goal? To stabilize an economy ravaged by hyperinflation for decades. But countries have tried this before, from Argentina in 1991 with its convertibility plan to various nations attempting currency boards. The track record is mixed, at best. The big question is, can Zimbabwe pull off what so many others couldn't? And what are the real risks for ordinary Zimbabweans now holding a gold-backed currency? Hey everyone, and welcome back. Today, we're talking about something fascinating, a story that's unfolding right now, with implications for anyone tracking global finance. Zimbabwe and its gold. You might have seen headlines, or perhaps heard snippets about their new gold-backed currency, ZiG, which launched just last month, replacing the old Zim dollar at a rate of roughly 25,000 to 1. Now, this isn't Zimbabwe's first rodeo with currency changes. Since 2009, they've cycled through 3 different local currencies, even using the US dollar as legal tender for a while. We're talking about a country where, at its peak hyperinflation in November 2008, the monthly inflation rate hit an astronomical 79.6 billion%. That's not a typo. Imagine prices doubling every single day. ATMs couldn't even hold enough zeros for withdrawals. In fact, a popular anecdote from that time described a wheelbarrow full of cash being worth less by the time you got to the grocery store. The big question, and why this matters for us today, is whether this new gold-backed approach will finally stabilize their economy. Because while the headlines focus on the gold, the real lesson here goes much deeper than just shiny metal. It's about central bank policy, about trust in institutions, and about the fundamental drivers of a stable currency. We're going to break down exactly what happened leading up to ZiG, why gold is so appealing in these situations, and what history tells us about countries trying to peg their currency to a hard asset. What this means for someone looking to understand global market stability is a stark reminder of the power of monetary policy and the fragility of trust. We'll look at the actual reserves Zimbabwe holds, how they plan to manage it, and what other central banks have done in similar predicaments. The lesson here is clear. Sound economic principles often trump the allure of physical assets alone. Now, this isn't Zimbabwe's first rodeo trying to stabilize its currency, but what makes this attempt particularly dramatic is the shadow of a truly staggering problem. A multi-billion-dollar gold drain. We're talking about an estimated $1.5 billion in gold lost annually to illicit trade. To put that in perspective, that makes it one of Africa's largest illicit financial flows. Think about that. $1.5 billion every single year. To understand the scale, Zimbabwe's official gold production has historically been much lower than its actual potential. Back in the 1980s, the country was hitting 18 to 20 tons of gold annually through formal channels. But fast forward to today, and even as artisanal mining has exploded, only a fraction of that gold passes through official channels like Fidelity Printers and Refiners, or FPR. Most of it is smuggled out. This missing $1.5 billion could be transformative. It's revenue that could fund essential public services, help stabilize the economy, and directly address poverty. Instead, it fuels a deeply entrenched parallel economy. The bulk of this gold comes from informal and artisanal miners, often referred to as makarakoza. These individuals work under incredibly difficult conditions, producing a significant portion of the nation's gold, but their output rarely makes it to state coffers. Instead, it's often diverted by a shadowy network, enriching a select few while the country's development suffers. The lesson here is that a new currency, even one backed by gold, faces an uphill battle when the very asset underpinning it is bleeding out of the economy at such a rapid rate. This massive drain isn't random, it's a highly organized operation. Now, who are these architects of theft? It's not just random individuals, it's a web of elite figures and cartels. One name that repeatedly surfaces is Kitakwash Tagwariai, often described as a close advisor to President Mnangagwa. Tagwariai is alleged to control a network of companies, including Secunda Holdings, Sotic International, and Undermining, all implicated in the illicit gold trade. These entities, according to reports like those from the Sentry, allegedly operate with preferential treatment, making it easier for gold to disappear from official channels. Consider the case of Henrietta Rushwaya, President Mnangagwa's niece. In October 2020, she was caught at Robert Gabriel Mugabe International Airport attempting to smuggle 6 kilograms of gold, valued at around $366,000, out of the country. This wasn't some small-time operation, it pointed directly to high-level political involvement. Arrested alongside her was Ewan McMillan, a figure later heavily featured in Al Jazeera's Explosive Gold Mafia documentary. McMillan was exposed as a central player in these smuggling networks, highlighting the international connections within this illicit trade. The Al Jazeera investigation also pointed fingers at other powerful individuals, like tobacco magnate Simon Rudland, for his alleged role in money laundering and facilitating the illicit gold trade. What we see here is a cartel-like structure. Political elites, elements within the security forces, and powerful business figures allegedly collaborating to control the gold supply chain from mine to market. They often bypass state regulations and official declaration processes, creating a parallel economy that funnels wealth away from the state. The lesson here is that when illicit financial flows reach this scale, they are rarely possible without high-level complicity. So, with such a sophisticated network, how exactly does this gold leave the country? Percent of Zimbabwe's entire annual budget. It's a gold hemorrhage, and it's a massive obstacle to any attempt at economic stability. Now, how does all this gold actually leave the country? We're talking about sophisticated operations that exploit every weak point. One primary method is plain old physical smuggling of raw gold. Take the notorious case of Henrietta Rushwaya in 2020. She was caught at Robert Gabriel Mugabe International Airport trying to smuggle 6 kilograms of gold, valued at around $333,000 at the time, on a private plane to Dubai. This wasn't an isolated incident, it's a symptom of a larger problem. Another major leak is through the black market. Here's how it works. Artisanal miners, who produce a significant portion of Zimbabwe's gold, are often paid slightly above the official price offered by Fidelity Printers and Refiners, the state-owned buyer. For example, if Fidelity is offering $60 per gram, the black market might offer $62. This small difference is enough to incentivize miners to bypass formal channels, especially when coupled with quicker payment and less bureaucracy. This undeclared gold then finds its way into the hands of smugglers. Then there's the financial wizardry. Shell companies and complex financial structures are used to obscure the gold's origin and launder the proceeds. Entities like Sotic International, for instance, have been implicated in schemes where gold is undervalued or simply not declared for export. They might claim a shipment is worth $10 million when its true market value is $20 million, effectively smuggling half the value out of the country on paper. These operations often rely on private charters and well-connected individuals to move the physical gold, frequently destined for international markets, with Dubai being a primary hub. The lack of transparency and weak enforcement mechanisms at borders and within the mining sector are critical enablers, allowing these illicit outflows to continue unchecked. The lesson here is that the problem isn't just about gold disappearing, it's also about the sophisticated financial networks that then wash this dirty gold. Percent of Zimbabwe's entire annual budget. It's a gold hemorrhage, and it's a massive obstacle to any attempt at economic stability. Now, how does all this gold actually leave the country? We're talking about sophisticated operations that exploit every weak point. One primary method is plain old physical smuggling of raw gold. Take the notorious case of Henrietta Rushwaya in 2020. She was caught with 6 kilograms of gold in her carry-on luggage at Robert Gabriel Mugabe International Airport, attempting to board a flight to Dubai. That gold alone was worth over $300,000 at the time. This isn't just about raw gold, though. A more complex layer involves money laundering operations, which are intrinsically linked to this illicit trade. The proceeds are often routed through multiple international jurisdictions, specifically to obscure their true origin. Consider the alleged involvement of figures like Kamlesh Patni, the Kenyan businessman infamous for the 1990s Goldenberg scandal, where Kenya lost an estimated $600 million. Patni has been implicated in the contemporary Zimbabwean gold laundering network, showcasing how these financial crimes often have a long, cross-border history. The mechanism for washing this dirty gold often involves selling it to seemingly legitimate international buyers. These buyers, whether witting or unwitting, then facilitate the movement of funds. The proceeds from these sales are then repatriated, often through a labyrinth of offshore accounts and shell companies. Dubai, in particular, has emerged as a critical international financial hub and a major free trade zone for smuggled gold. A report by The Sentry, an investigative organization, detailed how Zimbabwean gold often finds its way to Dubai, where it's melted down, restamped, and sold as legitimate. This process effectively sanitizes the gold and its illicit profits. The lesson here is that these sophisticated money laundering schemes deprive Zimbabwe of crucial tax revenue and foreign exchange. This direct financial drain exacerbates currency instability, like what we saw with the ZiG, and severely limits the government's capacity to fund essential public services. This leads directly to the widespread collateral damage we're seeing, undermining a nation's stability. Billion in illicit gold annually, remember? That's about 4.5% of their entire GDP, just siphoned right out. Now, what does this mean for a country like Zimbabwe? For someone in a situation where they're trying to build a stable economy, this kind of drain is devastating. It means billions in potential tax revenue just vanishes. In 2022, when the IMF was projecting Zimbabwe's GDP to be around $29 billion, $1.5 billion loss to illicit gold would translate to huge budget deficits, making it nearly impossible to fund essential services, infrastructure, or education. We saw similar challenges in the DRC during the early 2000s, where conflict minerals funded militias and crippled their formal economy for years. This siphoning also turbocharges corruption within state institutions. When powerful cartels like those allegedly linked to Kidakwash Tagwari are operating, they don't just walk in, they pay their way in. We've seen reports alleging that officials across customs, the police, and even the mining ministry are compromised. This isn't just about a few bad apples, it's about a culture of impunity where the rule of law is eroded. For instance, the infamous Gold Mafia documentary detailed how officials allegedly accepted bribes, creating what amounts to a parallel state where gold flows freely for those with the right connections. And who truly suffers from this? It's often the artisanal miners, the men and women digging for gold with their hands. They face brutal exploitation, dangerous working conditions, and environmental degradation, all while the true value of their labor is stolen. They get paid pennies on the dollar, while the elites benefit from the full international price. The lesson here is that unchecked illicit trade creates a multi-layered victim. The nation itself, its institutions, and its most vulnerable citizens. This isn't just about gold, these illicit funds are then often used to finance other illegal activities, further entrenching organized crime and destabilizing the region, creating a perpetual cycle of financial bleeding. So, the lesson here isn't just about gold disappearing from a mine shaft, it's about an entire nation's potential being systematically excavated. When we look at that $1.5 billion in illicit gold annually, representing 4.5% of Zimbabwe's GDP, it's not just a statistic. It's the hospitals that aren't built, the schools that remain underfunded, the infrastructure projects that never materialize. This isn't just a crime, it's an economic war against the people of Zimbabwe, orchestrated by a shadowy network that has mastered exploiting every financial loophole and political vulnerability. The true cost of this illicit trade is measured in lost opportunities, deepening poverty, and a continued struggle for economic independence. Now, considering the sheer scale of the actors involved, from well-placed officials to international corporations, what do you think is the single most effective first step Zimbabwe could take to start plugging this gold hemorrhage? Drop your thoughts and solutions in the comments below. If you want to understand how these global financial systems can be manipulated, and what it means for someone building a sustainable financial future, make sure to hit that subscribe button. And if you're curious about how other natural resource-rich nations struggle with similar issues, you'll definitely want to watch my deep dive into the true cost of diamond mining and the economies it props up. It's another example of how valuable commodities can become a curse rather than a blessing.